Hello friends, how are you doing out there? This is Vijay Bambani here and I'm back again in this weekly market outlook video. I hope you paid attention to the video of last week wherein I specifically told you that volumes are falling, and I also shared a snapshot window with you giving an example of how the bid and offer spreads can widen. Thereby you could get entries, but exits would become a little more difficult. You might have to sacrifice some amount of your profits after you make an entry into a trade just to be able to get an exit. If you've been monitoring your trading terminal screen, all that happened and how. Why does this happen and how did I foretell you this? Number one, I trade. Number two, I use statistical models, and these were warning that such a situation might just come to pass. What is the situation this week? I'm going to take it forward from here. But before I proceed, let me share two bits of information with you, which I'm fairly excited about. You see, last Saturday, I was extremely exhausted from kind of keeping awake on Thursday and Friday nights waiting for OPEC to come to a decision, which they didn't. And I wanted to update my friends over the WhatsApp updates that I do send out since many years. If you're in touch with me since the last couple of years, you would know by now. So I decided to send out a voice note because I was too tired to type out a message. Guess what? It became an instant hit. Last evening, I sent out the second voice note about an update on the RBI 10-year benchmark bond yield, which I will take it forward like I said in the voice note last night. I will take it forward in this video also. I intend to send my WhatsApp list recipients these updates, but do remember, I am not into stock tips. I talk about broader markets, broader economy, things of geopolitical importance that will impact the markets, but I will stop short of giving you trades. That's not what I'm here for. I'm not a tipster. All right. So let's dive right in, and coming up on your screen is a daily market roundup which shows that the Nifty fell a tad, but the Bank Nifty rose mildly on a week-on-week basis. This was partly due to falling oil and gas prices, which helped because these normally trigger inflation. The fact that the dollar fell also provided relief to emerging markets, including India, because a rising dollar triggers what we call imported inflation. Now, since India is a net importer, two-thirds of our imports are fossil fuels, which are rising anyway, by the way. A strong dollar makes the landed cost of imported fuel even more expensive, and that in turn pushes prices of meats, fruits, vegetables, pulses, etc. So a weak dollar kind of came to the help of the bulls, which is why the markets didn't fall much. Bond yields, as you can see, jumped, and this is a segment that I will cover in somewhat greater detail later. Take a look at the MWPL chart, which rose, which is routine because till the third week of any derivative cycle, traders do tend to raise their exposure in the markets. The chart, however, shows a fairly rapid rise in the open interest, and this was thanks to the retail segment, which was kind of raising their long position exposure. We'll come to those charts also later. Now take a look at the index and the stock volumes chart on your screen. Now do remember that these are cumulative volumes, which means July, August and September series. So the stock futures volume, as you can see on your screen, is at its period lows, and the index volumes have risen on a week-on-week basis, but just about. Now this is not exactly great, which is why I warned you last week itself that bid and offer spreads will widen, and that is precisely what happened. And the noticeable thing that I also saw on this chart is that volumes tend to rise on days that the markets are falling, and they are poor on days that the markets are bullish. Now this is not exactly very good news. I would want the situation to reverse ideally. Now, look at the basis chart. Now, the basis is nothing but the premium enjoyed by the future over spot. All right. So, this expanded fairly sharply due to short covering in the tail end of the trading session on Friday. Now, watch this aspect daily because it provides valuable cues on the near-term trends. And I update this on my social media pages every day. So do connect with me to get updated on a day-to-day basis, late evening every day. My contact coordinates will come at the end of this video. Now check out another in-house study that you won't find anywhere in the public domain. This is from our in-house statistical model, the Barracuda, which is the impetus or the velocity chart. Is there any surprise after seeing this chart that the Bank Nifty is showing relatively more signs of life compared to the Nifty 50? Now, this is why the Nifty has been somewhat poorer as compared to the Bank Nifty, because the impetus, the bullish impetus has been somewhat weaker. Is this a huge red light? I don't think so. If the bulls get back to life, if they kick off their lethargy and start bidding up prices again, the impetus can rise. But unless it does, it's still a nagging worry. Now, check out the most watched metric from us. And this metric, by the way, I've noticed, and people have sent me screenshots of various WhatsApp and Telegram groups, which are blatantly copying from me. Hey guys, we came here first. But you guys don't even bother to change a few words here and there. It's a simple copy-paste job. Shame on you. So, I'm talking of the FII, DII, and prop and retail traders footprint. FIIs have cut some stock shorts and they are now standing at 18,209 lots from an earlier figure of 42,165 lots. Their index longs have also been reduced to 13,893 lots from 57,874 lots. Now that indicates caution. Now DIIs, the domestic investment institutions, continue to step up their stock shorts, which are now at, hold your breath, 11,61,356 lots from last week's 11,42,868 lots. And they've reduced their index future shorts mildly from 55,899 lots to 50,714 lots. They are unmistakably betting on declines in the market. Now let's take a look at the prop traders. Brokers own individual trades and their specialists taking bets in the market. Now these guys are typically better clued on about markets because they know what FIIs are buying and selling. Now FIIs have stepped up their stock futures longs to 1,92,169 lots from last week's 1,83,755 lots. Their index futures longs are up to at 16,658 lots from an earlier figure of 7,715 lots. Now take a look at the retail activity, wherein retail traders, who are the largest holders of individual stock futures long positions, they've basically ramped up their index longs to an all-time high of 20,163 lots. And last week they were negative. They were net short of 9,700 lots. And their stock longs are now at 9,87,396 lots as compared to last week's 10,01,278 lots. Now, let's take a look at the 10-year benchmark bond yields. This is where excitement occurred on Friday. And I've already appraised you via that WhatsApp voice note about what happened. So I'm going to pick up the strings from where I left off and I'm going to take it forward. Now the RBI Governor has issued fresh bonds at 6.10% as against the previous coupon rate of 5.85%. That I already updated you. Not only that, he signaled an open mind about the RBI being ready to allow interest rates to go up, which means the government is willing to borrow money at higher interest rates. The bond buyers were resisting investing at lower yields in view of rising inflation, and they have finally prevailed upon the RBI to raise rates. And do remember that the government is a spender of last resort, which means when everything else fails, the government comes and spends money to boost the economy and stimulates the economy by way of financial stimulus. Now the government is willing to raise money at higher prices, and do remember that our Honorable Finance Minister had planned on raising 12 lakh crores via the bond markets. A chunk of it, a major chunk of it, was to be raised in the first half of the financial year, which means between 1st April 2021 to 30th September 2021. Well, it's mid-July and no big mop-up has occurred, which means that all fresh borrowings will ideally have to come at higher interest rates for the government. Now, herein lies a question with which high net worth individuals, people who are serious investors in the market, will immediately identify with. Friends, just imagine your bank fixed deposit interest rate is almost, I'm saying almost, at the same rate at which the 10-year benchmark bond yields are. You are getting the sovereign guarantee of the central government of India yielding 6.1%, and your bank FDs are somewhat lower. Can this situation prevail? If you're a Nifty trader, if you're an investor in bank stocks, this is something that should raise your hackles. Can the banks raise money at interest rates lower than the central government guaranteed bonds? My answer is no. They will have to raise rates, which means the cost of funds of banks will go up. Now, I'm not saying that on Monday you should go out there and short the Bank Nifty, because logic is not on the bus anymore. Logic flew out of the window a long time ago. But savvy traders will know what it means, that the cost of money is going to go up. Now, I expect over time, like I said, the banks will have to raise coupon rates, because big check writers aren't going to be writing big checks at these interest rates. And this will have a direct bearing on the Bank Nifty, but over a period of time. So in the near term, the retail guys might go on with the herd and play with the momentum. But you, the smart guys, should always have one eye in the back of your head open that cost of money is going up. So play very, very carefully. Go long, go with the flow. We are traders. We are here to go with the flow, but be extremely careful, my friends. Keep your phone handy and watch out for your WhatsApp voice messages. Remember, only very broad market issues. I don't give out stock tips. Now, let's take a look at the Dixie, the US dollar index, which is the US currency, the greenback, as a benchmark against the global basket of currencies. Now, our markets didn't fall further, and which is because the Dixie fell on 3 out of 5 trading sessions. I've been talking of 93.5 as a resistance level, which remains in place. Unless this is overcome, a fresh up move will be very difficult. The price remains above its 25-day exponential moving average, which means the short-term outlook remains positive for now. And the 91.5 level remains a short-term support. Now, let's take a look at the weekly chart, which shows an inverted bearish hammer, which means the price attempted to rally, but the bears hammered it down towards the end of the week to the lower end of the intraday range, which is why the inverted hammer was formed. The price, though, remains above its 25-week exponential moving average, which means the medium-term outlook remains positive. But here again, you need to go above the 93.5 resistance level before a clear breakout can occur. Now, this benchmark index is important from the point of view of rising oil and gas prices. You've already heard a lot about rising fuel prices at the pump in the media. But why is this index important for you? Because we import our oil and gas. And as a matter of fact, 2/3 of all our imports are fossil fuels, which is oil and gas. And if the dollar is to become more expensive, then the landed price of fuel, not only fuel, electronics, technology, clothes, shoes, automobiles, etc., will all become more expensive. So that will result in imported inflation. And that is something the markets don't like. Now, whether you trade currencies or not, do watch this index, no matter what somebody tells you. And last week, I advocated a range between 93.30 on the upside and 91.15 on the downside, which held perfectly well. The coming week should see an estimated, I stress upon the word estimated, range between 93.20 on the upside and 91.05 on the downside. So 93.20, 91.05. Please don't ignore the dollar index under any circumstances. Friends, let's now go to the Bank Nifty, and this index saw a mild 0.75% gain on a week-on-week basis after it rose on 3 out of 5 trading sessions. The last 2 sessions of the week, Thursday and Friday, were where the falls actually came. And the price fell below the 25-day exponential moving average on an intraday basis, but it bounced back towards the close. The 36,000 round figure acted as a glass ceiling, which means a temporary hurdle. And we need to see a breakout above the 36,000 mark before the bulls can command leadership position again. Let's now go to the weekly chart, where you can see the inverted candle, which means the bull attempted to rally, but the price settled at the lower end of the weekly range. Here, the price remains above its 25-week exponential moving average, which means the medium-term outlook remains positive for now. The same prognosis is seen on the weekly chart as well. The bulls must overcome the 36,000 hurdle, the round figure, before a rally can set in. Now, the week before last, we saw this index at number 3 on the most volatile list, and it slipped 1 notch last week to number 4, which means that stock volatility rose higher than the Bank Nifty volatility. In the week gone by, I advocated a range between 36,325 on the upside and 33,300 on the downside, which held perfectly well in spite of all that volatility. In the coming week, I expect estimated, I stress upon the word estimated, range between 36,525 on the upside and 33,600. So it's 36,525 and 33,600. I think, my friends, you should continue to trade fairly light. Friends, let's now go to the Nifty 50. This is the most liquid and low impact cost traded instrument on the NSE derivatives platform, and this saw a mild fall on a week-on-week basis because it fell on 3 out of 5 trading sessions. Here, like the Bank Nifty before it, the price fell below its 25-day exponential moving average intraday on Friday, but pulled up in the last hour of trade. The 15,625 odd level. The reason why I'm saying odd is because you need to allow a certain amount of leeway for emotional turbulence, because the traders are not mathematical, they are emotional people. So the 15,625 odd level remains a short-term support to watch out for, which is a swing low, a recent swing low. Note how the 15,900 level has been tested multiple times, but the bulls are unable to surpass it, which means the guys who are holding long positions are not able to recover their cost of carry, which is the interest cost a bull pays for carrying over his long positions, in this case from the month of June to July. Now, we need a breakout above the 15,900 round number for the bulls to start flexing their muscles again and show that they are the boss. Last week, I warned you about falling volumes and widening bid and offer spreads. That's something that I saw on the Nifty on my screen, believe me, on all 5 trading sessions. And ingress and egress, which means entries and exits particularly, were fairly labored. So you would have noticed that from your trading terminal screen from Monday onwards itself, of course. Now let's take a look at the weekly chart. This shows a second consecutive fall with the red candles on your screen, but the price remains above its 25-week exponential moving average, which means the medium-term outlook remains positive for now. Should the bulls push ahead, they have a fighting chance to succeed by triggering another rally. In the week before last, this index was number 22 on the most volatile list, but it rose one notch to number 21, which means the statistical beta or pure price volatility is rising. Now, this is a challenge for the retail intraday trader, which is why I've been advocating on my social media pages that you must continue to trade light. In the week before last, I advocated a range between 16,175 on the upside and 15,250 on the downside, which held perfectly well. Next week, the estimated, I stress upon the word estimated, range is between 16,125 on the upside and 15,250 on the downside. Now the Jensen's measure, this is a risk reward metric used by hedge funds managers. The Jensen's measure indicates caution. So I advocate trading on small exposure and avoid very aggressive big ticket trades, especially in the leverage segment. Connect with me on social media, wherein I update these details on a day-on-day basis. My contact coordinates will come at the end of this video. Friends, the index segment done. Let me come to the most popular segment of this video, which is top 5 high and low beta stocks to trade. Now, high beta stocks are stocks where you take big exposure, you take small exposure, you wait for large price moves to make your money, and low beta, low impetus stocks where you take big exposure, wait for small price moves to make your money. Why am I giving you two separate categories of trades? Because, hey, different traders, different trading regimens and different trading techniques. So, high beta, high impetus stocks led by Berger Paints at number 1, number 2, Shriram Transport Finance, number 3, Tata Motors, number 4, AU Bank, number 5, Ambuja Cements. Low beta, low impetus stocks, number 1, HDFC Life, number 2, Infosys, number 3, Petronet LNG, number 4, United Breweries, number 5, Bharat Electronics. Friends, this hierarchy of the most volatile and least volatile stocks can change hour to hour, day to day, which is why you must monitor these situations on a day-to-day basis. Like I said, connect with me on social media. I update these things on a day-to-day basis. Friends, if you like this video, do subscribe to my YouTube channel if you haven't already done so. If you want WhatsApp updates, do send me an email. My contact coordinates will come here at the end of this video. And do click on the bell icon to receive instant alerts about fresh videos being put about here. I'd love to hear your feedback in the comment section, so keep it coming. Also, in the description below this video are 2 hyperlinks. One to the Equity Master YouTube channel, wherein I put up 4 videos every week, and I put out a lot of my ideas. I would appreciate it if you could subscribe to that channel as well. And there is a link to receiving a free trading guide from Equity Master. Do make use of this opportunity. Thank you for your patience and watching this video. Till we meet again in my next video, do take very good care of yourself. I wish you have a very, very profitable week ahead, my friends. Take care. Bye-bye.